Right now, in 2026, a retired school teacher in Ohio is writing a check to the IRS for $14,000, money she does not legally owe. Not because she did anything wrong, not because her accountant made an error, but because nobody ever sat her down and explained that 3 specific accounts already exist inside the tax code where her money can grow completely beyond the reach of federal taxation. Not tax-deferred, not tax-reduced, not we'll deal with this later. Tax-free, permanently. And here is the part most people miss entirely. 2 of those 3 accounts have no ceiling on how much benefit they can generate for you over time. No cap on the growth, no limit on the advantage. The IRS does not mail you a letter when you qualify for something new. Your accountant is not financially motivated to find strategies that shrink next year's workload. What I am going to walk you through over the next 25 minutes are 3 accounts the tax code already permits, already identifies by specific name, and has permitted for decades, accounts most retirees never discover until after they have already spent years handing over taxes they never had to pay. What invisible actually means. Before I go any further, I want to be precise about something because I am not going to oversell this to you. When I say these accounts are invisible to the IRS, I mean something specific. The money inside them is invisible to the one thing that actually matters, your tax bill. The IRS cannot count a single dollar of it as taxable income. It does not appear on the line that determines what you owe. That is what invisible means in this context. Invisible where it counts? On your taxes. Here is the actual number most people never stop to calculate. If you retire at 65 with $500,000 sitting inside a traditional 401k or IRA, and you withdraw $40,000 per year to live on, every single dollar of that withdrawal is fully taxable as ordinary income. At a 22% federal rate, that is $8,800 per year in federal taxes alone, before your state even begins. Across a 20-year retirement, that adds up to $176,000 sent to the IRS from money you already worked for, already earned, and are now supposed to be living on. The 3 accounts in this video do not reduce that number slightly. They change which of your dollars the IRS is permitted to count as taxable income in the first place. And that is a fundamentally different thing from a deduction or a credit. A deduction lowers the number the IRS taxes. What I am describing removes the dollar from the conversation entirely. The order of the 3 accounts. Let me be specific about what is coming, because there is a deliberate sequence to these 3 accounts, and the sequence matters. Account number 1 works best if you are still earning income, even part-time. It has annual limits and income rules in certain situations, but done correctly, every dollar that goes in and every dollar of growth that comes out is completely untouched by the IRS. Account number 2 is the one most financial advisors mention briefly and then move past. It carries a 3-layer tax advantage that no other account in the entire United States tax code offers. And the majority of people use only one of those 3 layers, leaving the other 2 sitting completely idle. Account number 3, the one I'm saving for last buy, is different from the first 2 in one critical way. It has no contribution limit whatsoever. If I explain that one first, the first 2 will not seem as important anymore. So stay for it. Before I get into account 1, I want to ask you one specific question. Answer it in the comments right now. Are you currently paying income taxes on money you are pulling from a 401k or traditional IRA in retirement? Just type yes or no below, because the number of people who respond yes is going to tell me exactly how many people are encountering this information for the very first time. Type it now while I keep going. Also, hit subscribe and turn on the notification bell. The strategies I cover on this channel shift year by year because the IRS adjusts contribution limits, income thresholds, and qualified expense rules annually. The people who are subscribed find out before those changes take effect. The people who are not subscribed find out after it is already too late to act for that tax year. Why the order exists. The framework. I told you account 3 has no contribution limit and is the one almost nobody knows exists as a retirement strategy. I want to come back to that in a moment because I need to explain why the first two accounts exist before account 3 makes complete sense. Think of it this way. The first account is built specifically for your investment income, the money you are growing for retirement. The second account is built specifically for your health, one of the single largest expenses you will face once you stop working. The third account is for everything else. The money that does not fit anywhere else, the money above every limit, the money that would otherwise sit in a regular taxable brokerage account being taxed on dividends every year, taxed on capital gains every time you sell, and taxed again when you pull it out in retirement. That third account solves that problem, and for a great many retirees, it represents the largest pool of money the IRS is technically allowed to tax and simply does not. Keep that in the back of your mind as we work through the first two. It will all connect when we get there. Account 1, the Roth IRA. Account number 1 is the Roth IRA. And before you move on, because you have already heard of it, I want to be specific about what most people get wrong, because the way most people use a Roth IRA and the way it actually performs at maximum effectiveness are two entirely different things. Here is how it actually works. A traditional IRA or 401k takes your money before the IRS touches it, lets it grow, and then taxes you on every dollar when you withdraw it. A Roth IRA takes your money after taxes have already been paid, lets it grow, and then never taxes it again. Not on the growth, not on the withdrawal, not when you leave it to your children, never. That means if you put $7,000 into a Roth IRA this year and it grows to $70,000 over 20 years, the IRS sees $0 of taxable income when you pull that $70,000 out. That $63,000 of growth is completely invisible to your tax bill. The 2026 contribution limit is approximately $7,000 per year. If you are 50 or older, it is $8,000. That sounds modest, but the power is not in the contribution, it is in the compounding growth. $7,000 per year beginning at age 45 invested in a broad market index fund averaging 7% annual return grows to approximately $340,000 by age 70. Every single dollar of that $340,000 comes out in retirement with zero federal income tax owed. None of it. The two hidden benefits nobody explains. Here is where most people stop thinking about the Roth, and that is a significant mistake because the real power lives in these two additional layers. First, Social Security taxation. Most people have no idea that their Social Security benefits can be taxed at up to 85% if their combined income, including half their Social Security benefit, crosses $34,000 as a single filer or $44,000 as a married couple. When you pull money from a traditional 401k in retirement, it pushes that combined income number higher. When you pull from a Roth IRA, it does not count. The Roth withdrawal is completely invisible to that calculation. Second, Medicare premium surcharges. Medicare uses your income from 2 years prior to set your monthly Part B and Part D premiums. If your income crosses certain thresholds, you pay what is called IRMAA, the income-related monthly adjustment amount. In 2026, that surcharge begins when income crosses approximately $106,000 for a single filer. A retiree withdrawing $50,000 per year from a traditional IRA on top of other income can land above that threshold and pay elevated Medicare premiums every month for the rest of retirement. The same retiree drawing from a Roth instead keeps that income off the Medicare calculation entirely. That is a real recurring dollar difference on your monthly healthcare bill, month after month for the rest of your retirement. The income limit and the workaround. Now, there is a rule worth understanding. If your earned income exceeds a certain amount, you cannot contribute directly to a Roth IRA. In 2026, the phase-out begins around $150,000 for single filers and approximately $236,000 for married couples filing jointly. Above those numbers, the direct contribution limit phases down to zero. But here is what most higher income earners do not know. There is a completely legal method called the Backdoor Roth IRA. Here is exactly how it works. You open a traditional IRA. You make a non-deductible contribution, meaning you put in after-tax money and do not take a deduction for it. Then you immediately convert that traditional IRA to a Roth IRA. The conversion is only taxable on any gains that occurred between the contribution and the conversion DAR, which, if you move quickly, is essentially zero. The entire after-tax amount moves into the Roth, and from that point forward, grows completely tax-free. This is not a loophole. It has been specifically permitted by the IRS since 2010. Congress has had multiple opportunities to eliminate it and has deliberately chosen not to. Real example. Picture a 52-year-old marketing director earning $220,000 per year. She is above the income limit for a direct Roth contribution. For 20 years, she has been placing everything into a traditional 401k, not yet realizing that every dollar she pulls from that account in retirement will be taxed as ordinary income. This year, she executes the Backdoor Roth. She contributes $8,000 of after-tax money, converts it immediately, and begins building the tax-free side of her retirement for the very first time at 52. 18 years later, at age 70, that money has been growing inside a tax-free account. It comes out clean. None of it touches her Social Security taxation calculation. None of it triggers an IRMAA surcharge on her Medicare bill. Exact action step. Open a Roth IRA at a brokerage. Fidelity, Schwab, and Vanguard all offer them. If your income falls below the threshold, contribute directly up to the annual limit. If your income is above the threshold, open a traditional IRA alongside it. Make a non-deductible contribution and immediately convert it to the Roth. Record that contribution as non-deductible on IRS Form 8606 when you file. That form is what prevents you from being taxed twice on the same money later. Every dollar that compounds inside a Roth IRA instead of a traditional IRA is a dollar that will never inflate your taxable income in retirement. Never push a greater portion of your Social Security into a higher tax bracket, and never trigger an elevated Medicare premium. Done correctly starting today, this account alone can represent 6 figures of tax-free retirement income that the IRS never touches. That is account 1. Account 2, the HSA. I told you earlier that account 2 is the one most financial advisors bring up briefly and then move past. And the reason is specific. Most people use only one of its 3 tax layers and leave the other 2 completely untouched. Stay with me on account 2 because the 3rd layer is the one almost nobody knows about, and in retirement it is worth more than most people ever realize. Account number 2 is the health savings account, the HSA. And I want to be direct from the start. If you have heard of an HSA and think of it simply as a way to pay for doctor visits with pre-tax dollars, you are using approximately 1/3 of what this account is actually capable of. There is a reason it is described as the only triple tax-advantaged account in the entire United States tax code. Most people burn through 2 of those 3 advantages without ever realizing it. The 3 tax layers. Layer 1. Money you put into an HSA goes in completely tax-free. If you contribute through payroll, it bypasses federal income tax, state income tax in most states, and Social Security and Medicare payroll taxes. That is a combined tax savings of 20% to 40% on every dollar contributed, depending on your bracket and your state. Layer 2. The money grows inside the HSA completely tax-free. If you invest it, and I will come back to this, it compounds year after year without the IRS taking any portion of your gains. Layer 3. The money comes out completely tax-free when used for qualified medical expenses. No income tax on the withdrawal, none whatsoever. Here is what makes the HSA structurally unique. A traditional 401k gives you layers 1 and 2, but taxes you on every dollar going out. A Roth IRA gives you layers 2 and 3 tax, but not layer 1. The HSA is the only account in the United States tax code that gives you all 3 layers simultaneously. Money in, tax-free. Growth, tax-free. Money out for medical expenses, tax-free. The catch: to contribute to an HSA, you must be enrolled in a high-deductible health plan, an HDHP. In 2026, that means a plan with a minimum annual deductible of approximately $1,650 for individual coverage or $3,300 for family coverage. If your current health insurance does not meet those minimums, you cannot contribute to an HSA during that year. The 2026 contribution limits are approximately $4,400 for individual coverage and $8,750 for family coverage. If you are 55 or older, you can add an extra $1,000 catch-up contribution on top of that. The strategy most people miss. Most people treat an HSA like a short-term medical spending account. Money goes in, a medical bill arrives, money comes back out. That uses the first tax layer and leaves layers 2 and 3 sitting completely idle. The real strategy works like this: contribute the maximum every single year, invest every dollar of the balance, do not leave it sitting in cash. Pay your current medical costs out of pocket if you are able to, and let the HSA balance grow completely untouched. Here is why that matters so much. There is no IRS deadline to reimburse yourself from an HSA. If you pay a $400 medical bill out of pocket today and save the receipt, you can reimburse yourself from your HSA 5 years from now, 10 years from now, or 30 years from now. The IRS places no time limit on HSA reimbursements, provided the expense was incurred after the account was opened. That means by the time you retire, you will have accumulated years of out-of-pocket medical receipts, all of which you can draw from the HSA at any future point, completely tax-free. You have been quietly building a tax-free cash reserve the entire time, and the IRS never sees a single dollar of it as income. After age 65, the second function. Once you turn 65, an HSA does something else entirely. It begins functioning exactly like a traditional IRA for non-medical withdrawals. You can take money out for any reason at all. Non-medical withdrawals after 65 are taxed as ordinary income, the same treatment as a traditional IRA, but there is no penalty. Before age 65, non-medical withdrawals are taxed plus a 20% penalty. After 65, that penalty disappears entirely. So after 65, your HSA is either a completely tax-free account for medical costs or a standard retirement account with traditional IRA tax treatment for everything else. It is the only account that serves both functions depending on what you need. The retirement healthcare number. Here is the number that puts all of this in real perspective. The average American couple retiring today is projected to spend over $300,000 on healthcare expenses in retirement, not counting long-term care. Every dollar of that $300,000 that comes from an HSA, zero income tax. Every dollar of that same $300,000 that comes from a traditional IRA, taxed at your ordinary income rate. At 22% on $300,000, that is a $66,000 difference in taxes paid or not paid on the exact same medical bills. Real example. Picture a 45-year-old nurse enrolled in a high-deductible plan through her hospital. She begins contributing $8,750 per year to an HSA for herself and her husband. She invests the entire balance in a low-cost index fund. She pays all current medical costs out of pocket. She saves every receipt digitally. She continues this for 20 years until she retires at 65. Total contributions $175,000. At a conservative 6% annual return, that balance has grown to approximately $320,000. She has also accumulated $40,000 in historical medical receipts she can reimburse tax-free at any point. She enters retirement with a $320,000 tax-free medical account and a $40,000 tax-free cash reserve, both in the same account, both completely off her tax bill. Exact action step. Step 1. Call your health insurer and confirm your current plan qualifies as an HDHP under 2026 rules. Step 2, open an HSA with a provider that allows you to invest the balance, not just hold cash. Fidelity, Lively, and Health Equity all offer investment options. Step 3, contribute the maximum every year. Step 4, begin keeping digital records of every out-of-pocket medical expense from the day the account opens, every receipt, every copay, every qualifying cost. The HSA is the only account where money enters tax-free, grows tax-free, and exits tax-free, all three simultaneously. In retirement, where healthcare is often the largest and least predictable expense, holding a six-figure balance where every dollar covers medical bills without the IRS seeing any of it is a fundamentally different financial position than the one most people are currently building toward. That is account 2. The problem the first two don't solve. Here is what those two accounts still leave unresolved. The Roth IRA has an annual limit of roughly $7,000 to $8,000. The HSA has a family limit of around $8,750. Together, that is approximately $16,750 per year of money that can move somewhere tax-advantaged. What happens to everything else? What about the $50,000, the $100,000, the $200,000 sitting in a regular taxable brokerage account, being taxed on dividends every year, taxed on capital gains every time you sell, and taxed again in retirement when you pull it out? Account 3 handles that, and almost nobody uses it because almost nobody knows it exists as a retirement strategy at all. Account 3, the 0% capital gains bracket. Account number 3 is the one I have been building toward, and it is different from the first two in one important way. The Roth IRA and the HSA are accounts you open and fund. This third one is not an account. It is a rule, a bracket that already exists inside the tax code that allows you to pull money out of your regular investments and pay the IRS absolutely nothing on the gains. It is called the 0% long-term capital gains bracket. And most retirees have no idea it exists, or they assume it could not possibly apply to them. They are wrong. For a great many retirees, this is the single largest pile of money sitting in plain sight that the IRS is permitted to tax and simply does not. Here is exactly how it works. When you sell an investment you have held for longer than 1 year, a stock, a mutual fund, an ETF, inside a regular taxable brokerage account, the profit is classified as a long-term capital gain. The government taxes those gains at special rates that are lower than your regular income rates. Most people are aware of the 15% rate. What they do not know is that there is a rate below that, a 0% rate, not deferred, not reduced, not pay it later, a genuine zero. If your income falls below a certain threshold, you can sell appreciated investments, collect the profit, and owe the IRS nothing on that gain. It is, in every sense that matters, invisible to your tax bill. The exact 2026 numbers. Here are the specific 2026 figures. If your total taxable income, after your standard deduction, stays at or below $49,450 as a single filer or $98,900 as a married couple filing jointly, your long-term capital gains are taxed at 0%. 0%. Now, here is why this is so powerful for retirees specifically. Think about who tends to have low taxable income but meaningful appreciated investments. It is retirees, especially in those early retirement years after you have stopped working but before Social Security and required minimum distributions kick in and begin filling up your income. In that window, your income drops considerably, and that creates room. Room below that 0% ceiling where you can pull capital gains out completely tax-free. Picture a married couple, both 66, recently retired. They are living on $35,000 per year from a pension plus some dividend income, roughly $40,000 of gross income total. After their standard deduction, their taxable income sits well below the $98,900 ceiling. They have tens of thousands of dollars of room underneath it. So they sell appreciated stock they have held for years, stock with a $60,000 gain built up inside it. Because that gain stacks on top of their modest income and still lands beneath the ceiling, they owe the IRS zero in federal tax on that entire $60,000 gain. $60,000 of profit, zero federal tax, because they understood where the line was and they managed to stay beneath it. That is money the IRS is legally entitled to tax and receives none of. Resetting your basis, the repeatable strategy. Here is the piece that turns this from a one-time move into a repeatable annual strategy. And almost nobody knows this part. When you sell that appreciated stock and capture the gain at 0%, you are not required to exit the investment. You can turn around and buy it back immediately. With losses, a rule called the wash sale rule requires you to wait 30 days before repurchasing. But that rule applies exclusively to losses. It does not apply to gains. So you can sell to capture a gain at 0% and buy the exact same investment back the very next morning. Why would you do that? Because it resets what is called your cost basis to the new higher price. All of that appreciation you just locked in at 0% is now permanently protected. The next time you sell, your taxable gain starts from the higher number. You have effectively erased years of accumulated taxable gain without paying a cent to do it. This is called tax gain harvesting, and in every low-income year of your retirement, you can repeat it, resetting a little more each year tax-free as long as you stay below that ceiling. The catches. Being straight with you. I promised you accuracy, so let me give you the real boundaries, because this is where people make expensive mistakes. First, the capital gain stacks on top of your other income. The question is not simply what do I earn, it is how much room remains beneath the ceiling after your Social Security, pension, and any IRA withdrawals are already counted. If those sources push you close to the line, you have less room than you might expect. You have to run the numbers each year. Second, realizing a large gain raises your income for that year, and that creates side effects. It can make a greater portion of your Social Security taxable. It can push you above the IRMAA threshold and trigger a higher Medicare premium 2 years later. You do not want to chase tax-free gains and accidentally trip a different tax somewhere else in the process. Third, this is the federal rate only. Your state may still tax the gain. If you live in a state with no income tax, Florida, Texas, and several others, you are clear. If you are in a high-tax state, factor that into your calculation. And fourth, the investment must have been held longer than 1 year to qualify as long-term. Sell something held less than a year and it is taxed as ordinary income, no zero bracket applies. None of those are reasons to avoid this strategy. They are reasons to execute it carefully. Ideally with a quick projection of your full year income each fall before you sell anything. Exact action step. Before the end of any year where your income is lower than usual, especially those early retirement years before required minimum distributions begin, sit down and estimate your taxable income. Subtract your standard deduction. Then look at the gap between that number and the 0% ceiling. $49,450 for single filers, $98,900 for married couples. That gap is the dollar amount of long-term gains you can sell completely tax-free this year. Sell appreciated investments you have held over 1 year up to that gap. If you want to stay in the investment, buy it back the following day to reset your basis higher. And if you are unsure where your income lands, this is exactly the kind of projection a fee-only advisor or CPA can complete with you in an afternoon, for far less than the tax you would otherwise pay. Real dollar consequence. A retiree who ignores this bracket sells investments whenever they happen to need money and pays 15% on every gain year after year. A retiree who understands this bracket times their sales into lower income years, harvests gains at 0%, and resets their basis higher with each cycle, pulling tens of thousands of dollars of profit out completely tax-free across the course of their retirement. Same investments, same money. The only difference is knowing the line exists and staying beneath it. What all three have in common. Here is what all three of these strategies share, and this is the part that matters most. None of them are tricks. None of them are loopholes awaiting closure. Every one of them is written directly into the United States tax code. The Roth IRA has been explicitly permitted since 1998. The HSA has been embedded in the tax code since 2003. The 0% capital gains bracket is written into the tax code at Section 1, Paragraph H, with the income thresholds reset by the IRS every single year. These are not new strategies. They are strategies the financial industry has limited incentive to proactively walk you through, because the money you shelter inside a tax-free account is money that is not generating management fees somewhere else. Final summary. To bring it all together one final time clearly, Account 1, the Roth IRA, permanently removes your investment growth from the IRS's reach. It protects your Social Security from higher taxation. It shields your Medicare premiums from income-based surcharges. Done correctly and started today, it can represent 6 figures of tax-free retirement income the IRS never touches. Account 2, the HSA, is the only triple tax-advantaged account in the entire United States tax code. Used correctly as an investment vehicle rather than a short-term medical fund, it builds a 6-figure tax-free reserve for the largest and least predictable expense most retirees will face, healthcare, while simultaneously functioning as a standard retirement account for everything else after age 65. Account 3, the 0% capital gains bracket, allows you to sell appreciated investments and pay 0 federal tax on the gains in any year your income stays below the ceiling. Time it to your lower income years. Reset your cost basis higher each time and pull tens of thousands of dollars of accumulated gains out completely tax-free over the course of your retirement. Share this video with anyone you know who is placing every dollar of their savings into a traditional 401k or a taxable brokerage account, believing those are the only options available. One conversation about these 3 accounts before retirement is worth more than any tax strategy attempted after the money is already gone. Subscribe. Share this with the specific person who needs to see it, and I will see you in the next one.